Okay, so again, here's all the variances. And by the way, most of these, at least the first 6 of these variants for material, labor, and overhead, you use this general formula. Budget variance and volume variance, obviously, we're not. So let's take a look at the financial accounting of these variances. So here's our finished goods T account, COGS T account, material quantity, material price variance T accounts, and the labor efficiency and rate variance. And then we have one manufacturing overhead. One manufacturing overhead T account. Notice we do not have a variable overhead rate and a variable overhead efficiency variance. There's no T account for that in the real world. So we received $435,000 worth of product. That is the $87 per unit times the 5,000. That went into finished goods. Then we sold it and we took it out of finished goods and put it into COGS. We have to ultimately close all of these variance accounts. We're going to close MQV. When we do, this is an unfavorable variance. Why is it unfavorable? Well, when we credit it to close it and bring it to zero, we're going to debit COGS, which is going to increase COGS. But we had a favorable material price variance. To close it, we're going to debit it, and we're going to credit COGS, thus reducing cost of goods sold. Labor efficiency variance and labor rate variance are both unfavorable. We're going to credit them to close them out, and we're going to debit COGS, thus increasing cost of goods. Now, on the overhead side of the equation, recall in your book, the debit side was where we accumulate all of our actual overhead, and on the credit side is where we apply overhead. Recall from the earlier vignette where I outlined what actually occurred, we had $40,950 worth of variable overhead, and we had actually incurred $108,000 of fixed overhead for a total of $148,950. But we applied $150,000 of overhead. We built 5,000 units. It takes 2 hours to make them. The overall overhead rate is $15 an hour. Therefore, we over-applied overhead to the cost of goods. This $1,050 is, in fact, the net amount of these 4 variances: the 2,000 unfavorable variable overhead efficiency variance, the 1,050 favorable rate variance, the 2,400 unfavorable budget variance, and the 4,400 favorable volume variance. When we close those out, because this is going to be closed, we are going to debit the overhead account, and we're going to credit COGS, thus lowering COGS. So once that's all done, we're going to culminate in the next vignette and see how much did we really make based on the standard costing system.